Would you rather have $100,000 right now or a single penny that doubles every day for a month?
I feel like this is a trick question, but I can't resist the 100K.
$100,000 is tempting, but by day 30, the penny that doubles every day will grow to over $5 million. Today, we're talking long-term investing, considerations on how to do it, how investing health relates to physical health, and why it's important for your financial future. I'm Anna Neres. Around here, there are no bad questions. Be sure to like, subscribe, and ask away. So, what is long-term investing? Long-term investing sounds simple enough. I put money in, I leave it alone, and I let it grow. So future Anna has stability, freedom, and a little less to stress about. Easy, right? Not exactly. Effective long-term investing is active. It involves making regular contributions to your investment account and staying consistent through the ups and downs of the market. That's because historically, the longer you stick with a diversified investment plan, the higher your likelihood of positive returns. I like to think of it like this. A long-term investing plan is like a long-term training program at the gym. If I'm looking down the road at future Anna and I want her to be able to actually enjoy her retirement, scenic hikes, lifting grandkids, maybe even a little salsa dancing, I need to build a consistent exercise plan now. It's the same with long-term investing. My consistent contributions now can help give future Anna the financial freedom to take advantage of her physical fitness. But for any of that to work, I have to set a practical plan and stick to it. Maybe it's 3 days a week at the gym, and even when I'm tired and I don't want to go, I stick to the plan. And even when it's rainy outside, I stick to the plan. Even when it's snowy and icy, even then I stick to the plan. I do the same thing with my long-term investing. I set up a practical monthly contribution, and if the market's going up, I stick to the plan. And if the market's going down, I stick to the plan. You get it. Because as a long-term investor, time in the market is your greatest ally. Why? I'm glad you asked. Because of the effect of compounding returns. This is when your money starts making its own money through the returns on your initial investment. As those earnings stay invested, they start earning too. It's like your money's hitting the gym and making gains while you sleep. Let me help you visualize this. Savings Anna puts $100 a month in a traditional savings account that gives her an average return of 0.4%. After 30 years, she could build up about $36,000. Nothing to scoff at. Until we take a look at long-term investing Anna. She puts the same $100 a month for 30 years in a diversified investment that tracks the S&P 500, which has returned an average of 11% over the last 2 decades. While past performance does not guarantee future results, an 11% return would bring her total to a very flex-ready $226,000. Both Savings Anna and Investing Anna experience compounding returns, but at very different rates. An 11% rate of return will do a lot more heavy lifting than a 0.4% rate of return. The higher your returns, and the longer you stay invested, the more powerful compounding becomes. So how can you be like long-term investing Anna and aim to maximize your compounding returns? Well, if you haven't started already, you can start today. The sooner you build your plan, the longer compounding can help boost your results. But what should you invest in? Especially for long-term investing, diversification is key. That's the investment version of working every muscle group. Sorry, no skipping leg day. If you haven't watched our video on diversification, that's a great next step to strengthen your long-term investing strategy. I'll leave a link to that below. The headline is, iShares ETFs from BlackRock make diversification simple. They offer exposure to a range of investments in just a single purchase, keeping all your muscle groups working. You can choose from over 450 of them at iShares.com. If you want to learn more about ETFs, check out the episode links below. Investing carries risk. Before putting your money into anything, whether it's the market or a fancy gym membership, you should give it careful consideration. Always do your homework. I'll drop some links below where you can learn more. Remember, when it comes to investing, there are no bad questions. Drop your thoughts and questions in the comments and let me know what topic you'd like me to break down next. If you're ready to start your own long-term investing journey, don't forget to like, subscribe, and check out iShares.com. Visit www.ishares.com to view a prospectus, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Risk includes principal loss.